So today the IPO of Knowledge Realty Trust opens. Now this is a REIT. It would be the third REIT in India which is in the commercial office space. The fourth one is the Nexus, which is largely catering to the retail side of the segment. Now Knowledge Realty Trust will be the largest REIT in India based on the gross asset value, which is close to about 60,000 crore. It will be the second largest office REIT in Asia, and their portfolio currently comprises of close to about 46 million square feet of a total area. Their occupancy has also gone up from about 85% in 2023 to about 91% as of the last fiscal year. And some of the tenants that they have in their company include Amazon, Cisco, Franklin Templeton Asset Management, HDFC Bank, amongst others. So it's a healthy mix of GCCs as well as a lot of multinational companies. Yesterday, we got the announcement that the company has raised about 1,620 crore via its anchor book. Shirish Godbole, the CEO of the company, and Kaisar Parvez, CEO of Knowledge Realty Trust REIT, are now with us on the company. And this is a company which is backed by Blackstone, sponsored by Blackstone and the Satwa Group. Thank you very much for joining in, gentlemen.
Thank you for having us.
Thank you. So, Shirish, let me start with you. I remember from an earlier interview of ours where you spoke about targeting a mid-teens kind of a revenue growth. That's what shareholders should expect. See, that's ultimately what matters, right? So take us through the math behind that number. And how is your REIT different from what's available in the market right now?
Sure. So mid-teens total return is what we had discussed. And current return, a dividend yield of 7.2% stabilized, going up to 7.7 and 8.7. So a mixture of fixed return plus upside through NAV appreciation over a period of time. That's the mid-teen return. That's what we had discussed, and that's what we're looking forward to provide to our investors. And how we differ is in a number of ways, honestly. First of all, I think we've got a very solid portfolio of assets. They are very well located, diversified, primarily in the best office markets, Mumbai, Bangalore, Hyderabad. We also have a very small SEZ component. In today's markets, leasing SEZ space has not been easy thanks to the rollback of the tax concessions from the government. Third, we have a very good internal growth story. We have significant CAGR, as I've called it before, compounded annual growth rate per year of our NOI growth, which is 13%. And our mark-to-markets, the rents are way below where market rents are. So we have a 20% upside sort of potential to increase those rents over a period of time. So that's very positive for internal growth.
So for what percentage of your portfolio can we see a 20% escalation?
So it's $1.5 million per year sort of maturing. And so 1.5 million square feet per year will roll over, and that will see the appreciation
of 20%.
Of 20%, right? But going back, the fourth thing we have is a very good external growth story. So we have a mindset to acquire assets. We have a brand neutral platform in Knowledge Realty Trust, and we want to use that brand neutrality to attract more sellers into our portfolio. So we'll be growing and with an active mindset to acquire, which has not been the case, with other competitors going past. But the most compelling reason, I think, is when you add that together and offer it at our yield. We're offering 7.2, as I said, stabilized, where someone like an Embassy is trading below 7%, and then someone like a Mindspace is trading below 6%. And frankly, we think we have all the attributes, if not more. So that's what makes it a compelling buy.
Gentlemen, Kaisar, to you then, the utilization of your proceeds. You mentioned, Shirish, that you want to acquire assets as well.
Yeah.
Will the proceeds, some of it at least, be used to acquire some of those assets that you raised from the IPO? Or would it be used to pare down the debt at an SPV level? What are your utilization plans of your proceeds?
Yeah. So the complete raise of 6,200 crore is a primary raise. All of that will be used to pay down the debt. In fact, that money is essentially used to sort of improve our balance sheet and strengthen the portfolio. And post the money, really, our LTV becomes 19%, which is the lowest LTV in the listed space.
And so post which you will be debt-free at an...
Maybe 19%.
19%.
Yeah.
Got that. So currently, the portfolio is about 46.5 million square feet. You spoke about how you're actively going to be in the market to aggressively expand and acquire. So what have you set your eyes on?
So, for acquisitions, we're really being opportunistic, right? I think the key as a company going forward is we're going to make sure we have accretive acquisitions. These are going to benefit our DPU and distributions to our shareholders. And so it'll depend on the opportunity.
But is there something which is in the pipeline? Sorry to interrupt.
Well, we have multiple, sort of assets that we're going after. But I think they're too early. I think right now we want to get the IPO done, get our act together in terms of operations, and then sort of pursue the acquisitions immediately after. But we'll be in the major cities that we have already got a presence in. Pune is another example where we might expand into. Calcutta, maybe one more. And then over time, tier twos are getting attractive as well. So we'll keep our eyes open, but initially it's the major cities in India.
You're present in Gurugram, but is Delhi NCR not part of your expansion
Of course,
plans?
no, it will be. So I think we have one asset, but we're clearly looking out and will look to expand. It's a very strong market, and besides the three strongest markets that we have, Hyderabad, Bangalore, Mumbai, NCR is obviously the next one. So we'll look out for acquisitions as we go forward.
Kaiser, just to come back to the point about the dividend yield, right? It's 7.2%, it goes up to 8.2%. But now real estate is also a cyclical business. There are ups, there are downs. So, in a down year, where do you think the dividend yield can come down to? I mean, set the expectations right, for shareholders. Yeah. And especially as you are planning to expand even into tier 2 cities, where you may not be able to command the kind of rent escalation that you do in marquee properties in BKC, for instance.
Yeah. So I think that's a very relevant question. And I think we always say that real estate is cyclical and upturns and downturns. We take pride in the fact that our portfolio is very well positioned for the down cycles as well. And why we say that is because of a couple of levers of growth. So first, obviously a 13% NOI CAGR, which essentially comes from two big facts. One is obviously, sort of leasing up of the vacant spaces, but an even more is the mark-to-market potential of 23%, which is unlike any other listed peer. And what really sort of happens is that every time a lease expires, it gives us a natural reason for an uplift in our rents. And that's a big growth. The other big growth comes in from our contractual escalations, and those escalations, all our leases are contractually escalating at a 5% annually or a 12 to 15% every 3 years. So if you add all of these together, you're getting a yield of 7.2 on an average.
I get it, but this is the projection from FY25 to FY29, which is one real estate cycle that we're currently in, where your NOI projection is NOI is net operating income, projection is 13%. I meant, give us a sense, like say the last 10 years, last 15 years, where we've seen a cycle. What has been the average, operating income growth or the dividend? I mean, we don't have a dividend yield, but say the NOI growth.
Yes, so and exactly to that point, because our rents are much lower than the market, we have enough cushion and buffer.
Even beyond FY29.
Even beyond FY29, because we have 23%, our current rents are 23% lower than the market. So in some ways, it insulates through a down cycle as well, right?
And also I would add that, to Kaiser's point, we've got assets which are very well located, good quality. So what happens, Rima, is in a up market, they benefit, but even in a down market, they're able to weather the storm the best. And I think that's the beauty of the assets we have.
If you could give us a sectoral breakup as well of your assets, which sectors do you have the maximum exposure to? Because there has been a lot of chatter or a lot of news flow surrounding the IT sector and the layoffs that are happening there, so on and so forth. Do you see any impact because of that? Is it just a sectoral exposure?
I think that's a very relevant question. In fact, you're right. The IT services is going through a recalibration. Fortunately for us, the IT exposure, the traditional IT exposure is in low single digits. Most of our tech-linked exposure is through GCCs, and most of these GCCs operate very differently compared to like a project-based IT services firm. In fact, we take a pride in a massive, strong tenant diversity. 45% of our rents come from GCCs. And a big part of the other section comes from BFSI, pharma, engineering firms.
I think you also said last time, 7 out of the 10 large top 10 clients are also GCC.
Yeah, absolutely.
Just out of time. Thank you very much, both Kaiser and Shirish, for coming down and speaking to us. Wish you all the very best.
Thank you.
Thank you.
Thank you very much for having us.
Glad to be here.
All right, on that note, we need to slip into a very short break. Don't go anywhere. On the other side, we'll discuss the market technicals. Videsh Thakkar joins in.